Welcome. My name is Sean Creedeman. I'm the founder of Mojave Group, a boutique real estate development firm focused exclusively on urban infill in downtown Las Vegas. What I want to do today is walk you through a specific fund opportunity we're currently raising, Joshua Tree Equity Fund 1, and more importantly, explain why we believe the timing in downtown Las Vegas right now is as compelling as anything I've seen in over 2 decades in this business. This isn't a pitch in the traditional sense, it's a briefing. I'm going to give you data, context, and a clear picture of the opportunity. And at the end, if it resonates, we'll talk about next steps. Before we get into the fund specifics, I want to start with a simple question. When is the best time to invest in a district? The honest answer is before the institutions figure it out, before the land reprices, before the headlines call it a success story. That's precisely where we are in downtown Las Vegas today. Downtown Las Vegas is undergoing a structural transformation, not a cosmetic refresh, a structural transformation driven by three forces that rarely converge in one place at one time. The first force is healthcare expansion. The Las Vegas Medical District is one of the fastest growing healthcare corridors in the western United States. You have UMC, Valley Hospital, and the Kerkorian School of Medicine all clustered within walking distance of the projects in this fund. That means thousands of healthcare workers, nurses, residents, administrators, technicians who need quality housing close to where they work. That is foundational demand. Demand that doesn't evaporate with an economic cycle. The second force is cultural revitalization. The Arts District has moved from an eclectic neighborhood to a recognized urban anchor. Galleries, craft breweries, boutique retail, creative firms. Culture arrives first. Capital follows. That's not a theory, that's the pattern we've seen play out in neighborhoods across the country, from the Pearl District in Portland to Rhino in Denver to the Arts District in Los Angeles. Downtown Las Vegas is in the acceleration stage of that same arc. The third force is civic investment. The city's vision. 2045. Master plan is not a wish list. It's a capital allocation roadmap. The plan calls for compact, walkable, mixed-use density in exactly the districts where we're developing. That kind of policy alignment materially reduces execution risk and creates a long-term tailwind that private capital alone can't manufacture. When you combine those three forces, healthcare employment, cultural momentum, and government-backed urban reinvestment, you get the conditions that precede serious value creation. The institutional capital hasn't fully arrived yet. That's the window. I want to briefly tell you why I believe Mojave Group is positioned to execute on this thesis. I've spent over 21 years in real estate development. I've had oversight of more than $3 billion in projects across my career. And several years ago, I made a deliberate decision to narrow my focus exclusively to downtown Las Vegas urban infill because I believe this is one of the most compelling early entry urban development opportunities in the country right now. That focus is a competitive advantage. We are not a general real estate fund trying to deploy capital across multiple markets. We know these districts block by block. We know which parcels are entitled, which owners are motivated, and which sites align with the city's density vision. We've done the work before the capital arrives. We are also a boutique firm by design. We pass on most deals to focus on high conviction opportunities. The projects in this fund cleared a disciplined underwriting process. They're here because the numbers work, the timing is right, and the execution path is clear. Now, I want to give you some context for what that experience actually looks like in practice, because I think it matters for an investor to understand not just how long someone has been in the business, but what they've been doing in it. These are 6 projects from my career. Each one is different. Each one required a different skill set, and together they cover essentially every phase of the development process. NVIDIA headquarters in Santa Clara. I was brought in on the pre-construction side, working directly with NVIDIA CEO Jensen Huang and the Gensler architecture team. My job was to make sure the design being drawn could actually be built, that the vision was grounded in a real budget and a real schedule. That's a discipline that comes up in every single project I touch, aligning ambition with execution reality before money gets committed. T-Mobile Arena, home of the Vegas Golden Knights. I served as owner's representative, which means I was making management decisions on behalf of the LLC that owned the land, the parking decks, the central plant, and the arena itself. We built to full NHL and NBA league standards. That experience, representing ownership and protecting capital, is directly relevant to how I think about managing investor capital in this fund. Circa Resort and Casino, right here in downtown Las Vegas. This was a $1 billion project, 777 hotel rooms, a two-story casino floor, the world's largest sports book, stadium swim consisting of 6 swimming pools with a 130-foot outdoor LED display, an 8-story parking garage, and here's the context that matters most for this audience. It was the first major ground-up project built in downtown Las Vegas in over 40 years. Nobody had done it in this market in a generation. My role was working with city officials, architects, and engineers to make sure every code-compliant element was properly drawn, built, and inspected. That's exactly the kind of relationship and process fluency we bring to our projects today. Pac-12 Conference headquarters in San Francisco. Executive offices, a broadcast studio, and a full data center, all built out in an existing building in downtown San Francisco. Urban tenant improvement in a dense city environment on a tight timeline. Pattern recognition that translates directly to urban infill work. The Pearl at the Palms, a concert venue and recording studio in Las Vegas. This one is a good story. We demolished an existing movie theater and rebuilt it as a state-of-the-art venue in 6 months. Inside an operating casino, where construction noise is not allowed. That project is one of the best examples I have of what it means to execute under real constraints such as schedule pressure, noise restrictions, an active neighbor on all sides, and still deliver a finished product. That's just. And the Platinum Hotel, 17 stories, 255 units, right here in Las Vegas. At the time, it was the first condo hotel of its kind to be built in this market. Units that operated as a hotel but were individually owned, which created a genuinely novel set of inspection and delivery challenges that nobody had a playbook for. And we figured it out. I could tell you stories about each of these projects until you are well past ready to leave the room, but the takeaway I want you to walk away with is this. Across a 21-year career, I have touched every part of the development process multiple times at serious scale under real pressure. Pre-construction, budget development, owner representation, code compliance, construction delivery, urban infill in markets that hadn't seen new development in decades. That's what I bring to Joshua Tree Equity Fund 1. Not a theory about how development should work, a career of knowing exactly how it does. Here's something that doesn't get talked about enough. During the last recession, permitting in downtown Las Vegas essentially froze. New construction stopped. Sites went dormant. The pipeline dried up. And while the Strip continued its cycle of reinvention, the urban core was largely left behind. The result is a structural supply deficit. There are very few entitled, shovel-ready urban infill sites available in these districts right now. That scarcity isn't temporary. It's a function of years of underinvestment in the pipeline. At the same time, the cost to build is rising. Replacement cost per unit continues to climb. That means any project with a low land basis and existing entitlements has a structural cost advantage over anything coming behind it. And institutional buyers, the large equity funds, are still predominantly focused on stabilized yield. They want the building that's already full, already cash flowing, already de-risked. They come in after the value has been created. We come in before. That's not a reckless position, it's where the return is. The greatest value in development is created before stabilization, during entitlement, during vertical construction, during disciplined execution. That's where we operate. That's where Joshua Tree Equity Fund 1 is positioned. Let me walk you through the fund mechanics. Joshua Tree Equity Fund 1 is a Regulation D Rule 506C offering for accredited investors only. The target raise is $10 million, and units are priced at $1,000 each. We offer 2 unit classes based on commitment level. Class A units, $50,000 minimum, 7% non-compounding preferred return. And Class B units, $500,000 minimum, 8% non-compounding preferred return. Both classes benefit from the same project portfolio and the same underlying strategy. The target net annualized return is 15 to 18%. Target hold period is 3 to 5 years. The risk-return profile is opportunistic, meaning we are in the value creation phase, not the stabilized yield phase. That's intentional. On a per-project basis, the numbers look like this across our current pipeline. Hotel Buckley, 23 to 27% target IRR, 1.9 to 2.7x equity multiple, $15 million development cost, and it is fully entitled. Anya Apartments, 12 to 15% target IRR, 1.5 to 2.0x equity multiple, $3.75 million development cost, and is shovel ready. 308 Apartments, 19 to 25% target IRR, 1.5 to 2.0x equity multiple, $2.9 million development cost, and is also shovel ready. All three are Opportunity Zone eligible. More on that in a moment. The projects in this fund are not suburban repositions or value-add acquisitions. They are ground-up, compact, efficient developments built specifically for the workforce, healthcare professionals, and urban residents driving demand in three of downtown's highest momentum corridors, the Medical District, the Arts District, and Fremont East. Every unit is designed for walkability, technology integration, and long-term livability. Every site is aligned with the city's Vision 2045 master plan, the same plans directing density, zoning, and infrastructure investment into exactly these corridors. We build where density, demand, and civic momentum intersect. That's not a tagline, it's a site selection filter. We invest in three specific districts. Each has a distinct demand driver. Together, they give the fund diversified exposure to downtown's transformation without diluting conviction. The Medical District. Healthcare employment as a demand anchor is one of the most durable investment theses in urban real estate. Workers at hospitals don't work from home, they don't move their jobs to the suburbs, and they need quality housing close to their campus. Hotel Buckley, one of our featured projects, sits directly in this ecosystem steps from UMC, Valley Hospital, and the Kerkorian School of Medicine. Extended stay hospitality for medical staff, traveling professionals, and patient families is structurally underserved here. The Arts District. Culture is always the first chapter. The creative class moves into a neighborhood before anyone else recognizes its potential. They tolerate the friction of early-stage urban life in exchange for authenticity and affordability. Then comes the infrastructure, the coffee shops, the galleries, the co-working spaces. Then comes the capital. The Arts District is entering that second phase. The culture is established, the walkability is real, and the pricing hasn't fully caught up to the momentum yet. That gap is the opportunity. Fremont East. This is one of downtown Las Vegas's most active redevelopment corridors. Live-work-play density is building block by block. Anya Apartments and 308 Apartments, both shovel-ready projects in this fund, are positioned directly in that momentum. Workforce housing in an emerging urban neighborhood, ahead of broader market repricing. The demand fundamentals are among the strongest in the portfolio. Across all three districts, we're targeting vacant and underutilized parcels, the sites that the market has overlooked, but that the 2045 master plan points directly toward for density and mixed-use activation. We don't speculate on outcomes. We build them step by step. Acquire strategically located infill parcels, positioned in corridors aligned with downtown's long-term growth and the city's master plan initiatives. Optimize entitlements for density and highest use, unlocking value through zoning, design, and alignment with urban planning frameworks. Develop vertically with efficient, modern design, maximizing yield, walkability, and long-term asset performance. Stabilize and enhance value through execution, leasing, operational discipline, and market positioning. Refinance or exit based on market conditions, capitalizing on timing, not forcing it. This is where strategy becomes structure, and execution becomes return. From an underwriting discipline standpoint, we target land at 2 to 3 million per acre in the urban infill range. We use stress-tested assumptions, not aggressive projections, conservative leverage, and phased execution. The goal isn't to post the highest projected internal rate of return on a slide. The goal is to build a track record of disciplined execution that compounds into a long-term investor relationship. The distribution waterfall is straightforward and contractually structured. Yuswa. First, preferred return to investors. Second, return of investor capital. Third, subordinated promote participation by the manager. I want to be clear about that sequence. We don't participate economically until you've received your preferred return and your capital back. That's not a gesture, it's structural. Alignment is either written into the documents or it isn't. In our case, it is. One of the questions I get from sophisticated investors, and it's the right question to ask, is this: how do I know the manager's interests are actually aligned with mine? It's the right question because in a lot of fund structures, they aren't. The manager collects fees regardless of performance. The promote gets paid before investors are fully returned. The incentives look good on paper, but the documents tell a different story. So let me walk you through exactly how we've structured this fund because I think the details matter here. The first thing to understand is the promote structure. Our promote, the manager's profit participation, is fully subordinated. That means we do not participate in profits until you have received your full preferred return and your capital back, not partially subordinated. Fully, we get paid last. If the fund doesn't perform the way we've underwritten it, we don't get paid. That's the only structure I was willing to put my name on. Second, I have capital in this fund. Manager capital participation isn't something we talk about as a marketing point. It's something I believe in as a matter of conviction. When I'm writing a check alongside investors, I'm not managing someone else's risk. I'm managing my own. That changes how decisions get made, how conservatively we underwrite, and how seriously we take every cost and timeline assumption in the model. Third, there are 4 cause removal protections built into the operating agreement. Investors have the contractual ability to remove the manager for cause. That's not a standard clause in every fund structure, and I want you to know it's in ours. It exists because I believe accountability should be written into the documents, not just promised in a webinar. Fourth, capital call limitations. The fund has defined boundaries around our ability to call additional capital from investors. You are not signing a blank check. The structure limits our reach back to you, and those limits are contractual. Here is the way I think about all of this together. Alignment isn't a slide. It isn't a talking point. It's either in the documents or it isn't. Every one of these provisions, the subordinated promote, the co-investment, the removal rights, the capital call limits exists because it should be there, not because it was easy to agree to. When we do well together. When the fund underperforms, I feel it before you do. That's what real alignment looks like, and that's the only way I know how to run a fund. I want to talk about risk directly, because I think the way a sponsor handles this conversation tells you a lot about how they actually operate. There are sponsors who will minimize risk in a presentation. They'll use soft language, bury the hard stuff in the footnotes, and spend most of their time talking about upside. That's not how we operate, and it's not how I'm going to talk to you right now. Development involves real risk. Let me name it plainly. There is construction risk. Materials cost more than projected. Subcontractors underperform. Weather, supply chains, labor markets, any of these can create friction in a build schedule. Anyone who tells you otherwise hasn't built enough projects. There is market timing risk. We underwrite to assumptions about where rents will be, where cap rates will settle, and what the exit environment will look like at the end of a 3 to 5 year hold. We don't have a crystal ball. Neither does anyone else. And there is capital markets risk. Interest rates, lending conditions, and debt availability all affect both our construction financing and our eventual exit. That environment can shift during a hold period. We plan for it. We don't pretend it away. So the question isn't whether those risks exist. They do. The question is how you manage them. And that's where I want to spend a minute. We mitigate construction risk through phased development. We don't commit the full capital stack to a single binary outcome. We sequence execution deliberately so that early decisions can inform later ones. We mitigate market risk through conservative underwriting. When I say conservative, I mean it specifically. We do not model best-case rent growth. We do not assume peak cycle exit multiples. We stress test our assumptions and ask what the returns look like if things are slower and harder than we expect. If the deal still works in that scenario, we move forward. We manage capital structure risk through discipline in how we layer debt and equity. We don't overlever to chase a higher projected IRR. Leverage is a tool. Like any tool, it amplifies both upside and downside. We use it accordingly. And we protect exit timing by letting market conditions, not a calendar, drive when we sell or refinance. We don't force a disposition into a bad market to hit an arbitrary date on a schedule. Patient capital and patient exits are part of the same philosophy. Here is the distinction I want to leave you with, and I think it's an important one. The goal is disciplined risk management, not risk avoidance. Those are not the same thing. Risk avoidance means you don't develop. You sit in cash, you buy stabilized assets at compressed yields, and you accept that the return profile reflects how little risk you've taken. There's a place for that in a portfolio. This fund is not that place. What we offer is the return that comes from taking intelligent, well-structured, well-timed development risk and managing it with the kind of discipline that comes from having done this across $3 billion in projects over 2 decades. Sophisticated investors understand this distinction. They're not looking for a sponsor who pretends the risks don't exist. They're looking for one who has a credible answer for how each risk gets managed. I hope that's what you've heard in the last few minutes, because that's exactly what we bring to every project in this fund. What makes this fund different from a larger institutional offering isn't just the size, it's the access point. Development stage value creation in entitlement-ready urban infill is rarely available to investors at a $50,000 minimum. You get institutional quality underwriting and execution discipline without institutional scale, institutional delay, or institutional fees designed to extract value before you see a return. I want to close the formal presentation with this thought bites. This fund is not simply about units, square footage, or projected internal rate of return. It's about participating in the next chapter of downtown Las Vegas, creating housing where the city's master plan says housing belongs, building boutique hospitality where the healthcare district needs it, adding density and community to corridors that have been underserved for a generation. Every major urban renaissance has early investors who believed in it before the market validated them. Those investors didn't just capture financial returns, they built something lasting. If you believe in the direction downtown Las Vegas is moving, and I think the data makes a compelling case that you should, then Joshua Tree Equity Fund 1 is a way to position capital ahead of that story being told at full value. That window is open now, but it won't be open indefinitely. Here's what I'm asking you to do today. Not to commit, not to write a check, but just to take one next step. Schedule a downtown strategy call with me directly. 30 minutes is all. We'll go deeper on whichever project in the portfolio is most relevant to your situation, whether that's the Opportunity Zone tax strategy, the workforce housing thesis, or the boutique hotel opportunity in the medical district. Subscription and investor verification is handled through our Juniper Square investor portal when you're ready to move forward. But the conversation comes first. If you're an accredited investor and you're evaluating how to deploy capital into a high-conviction, tax-advantaged urban infill opportunity before the market reprices, then this is worth 30 minutes of your time. And now for the formal disclosure statement the lawyers make me read to everyone. This presentation is for informational purposes only and does not constitute an offer to sell or a solicitation of an offer to buy securities. Any investment decision must be made solely on the basis of the private placement memorandum, operating agreement, and subscription documents. All investments involve risk, including loss of principal. Target returns are not guaranteed. Okay, now a few questions and answers that are pretty common that I want to share with you as you are thinking about this opportunity. Question 1. What are the biggest risks with this fund, and how are you managing them? The honest answer on risk is that development stage investing carries execution risk. Construction timelines, permitting, and capital markets can all create friction. The way we manage that is through conservative underwriting assumptions, phased execution, and a capital structure that doesn't require perfect market conditions to generate acceptable returns. We plan for adversity, not just for the base case. Question 2. Why Las Vegas specifically? Isn't this still a casino town? The Strip and downtown Las Vegas are two fundamentally different economic ecosystems. Downtown is anchored by the Las Vegas Medical District and one of the fastest growing healthcare corridors in the western U.S., alongside a cultural district entering its acceleration phase and a workforce housing supply gap the market has not yet solved. The comparable markets investors typically reference, like Denver's Rhino, Portland's Pearl District, and LA's Arts District, have already repriced. That early entry window has closed. Downtown Las Vegas is one or two major institutional transactions away from the same inflection point. The city's Vision 2045 master plan is already directing density, zoning, and infrastructure investment toward exactly the corridors where we're building. We invest where the city is going, not where it's already been. Question 3. How many deals do you look at before committing to one? Why these 3 projects specifically? What made them make the cut? We pass on most deals. The projects in this fund survived a process that stress tests rent assumptions against flat cycle performance, models construction costs against current contractor pricing, and evaluates exit optionality across multiple buyer types. Hotel Buckley, Anya Apartments, and 308 Apartments cleared that bar because they share 3 characteristics that don't coexist easily. Low land basis, shovel-ready entitlements, and structural demand that isn't cycle-dependent. We don't build portfolios to fill allocation targets. We build them one high-conviction project at a time. Downtown Las Vegas is at an inflection point. The data supports it. The city's master plans are funded and moving. The healthcare district is expanding. The cultural corridors are gaining density and momentum, and the institutional capital that will eventually reprice this market has not fully arrived yet. That window between where the market is today and where it will be when the big money shows up is exactly where this fund is positioned. If what you've heard today resonates with how you think about deploying capital, I want to have a real conversation with you. Not a sales call, but a strategy conversation. We'll talk through where you are, what you're trying to accomplish, and whether Joshua Tree Equity Fund 1 is actually the right fit for your situation. If it is, we'll talk about next steps. If it isn't, I'll tell you that too. The QR code on your screen will take you directly to my calendar. 30 minutes, no obligation. I appreciate you spending this time with me today. Building something meaningful in downtown Las Vegas takes capital, conviction, and the right partners. I hope to speak with you soon. Thank you for your time.